Two roads to stock market success: defensive versus enterprising investors. In the stock market, one size does not fit all. Imagine two friends stepping into the world of investing. One friend is like a cautious gardener, planting only the hardiest, most reliable seeds and tending them patiently. The other is more of an adventurous treasure hunter, digging for gems in places everyone else overlooks. In Benjamin Graham's classic The Intelligent Investor, these two archetypes are known as the defensive investor and the enterprising investor, each with a distinct stock-picking strategy. And here's the twist. Both approaches can lead to success as long as you follow the time-tested principles Graham lays out. Today, we're diving into the stock selection secrets from chapters 14 and 15 of The Intelligent Investor, revealing how a careful turtle and a crafty fox can both thrive in the market. This part blew my mind. By the end, you'll see that being an intelligent investor isn't about IQ. It's about choosing the path that suits your temperament and sticking to it with discipline and heart. So, which road sounds like yours? Let's find out. The defensive investor. Safe and steady wins the race. Meet the defensive investor. The embodiment of slow and steady wins the race. This is the investor who values peace of mind over big thrills. If investing were driving, the defensive investor stays in the slow lane because getting to the destination safely is the goal. Graham describes this type as someone content with high-grade bonds and a diversified list of leading common stocks, always careful not to overpay for even the best companies. In practical terms, the defensive investor builds a fortress-like portfolio, one made of solid, time-tested companies that can withstand storms. Here's what that looks like. 1. Stability and size. Defensive investors stick to large, established enterprises. Graham suggests excluding small or obscure companies that can be more volatile. The focus is on companies big enough to have proven their resilience over many economic ups and downs. Think of household name corporations with global reach, the kind that won't vanish overnight. This gives the defensive investor a good night's sleep, knowing their money is in sturdy hands. 2. Strong financial health. Our cautious investor demands financial strength. Graham advises checking that a company's balance sheet is rock solid, for example, having at least twice as many current assets as current liabilities, a 2.1 current ratio, and modest debt levels. It's like a medical checkup for a company. Only the financially fit make the cut. This way, even if hard times hit, these companies have the muscle to survive. Here's what most people miss. Boring balance sheets can be beautiful. A company with little debt and plenty of cash might not be making sensational headlines, but it's far less likely to go bankrupt when things get rough. 3. Earnings consistency. The defensive investor doesn't chase speculative, here today, gone tomorrow earnings. They want a long history of stable profits. Graham insists on no earnings deficit in the past 10 years, meaning the company has been profitable every single year for at least a decade. This consistency is huge. It's like the company's batting average, a perfect 10 for 10 in recent years. Such a track record tells our investor, this business can handle recessions, wars, or whatever. It keeps on making money. If a company had a loss even once in the last decade, it raises a red flag for the defensive camp. Why risk it? There are plenty of fish in the sea that haven't lost money. 4. Dividend record. To the defensive mindset, cash is king, and a consistent dividend is a sign of a shareholder-friendly, reliable company. Graham famously recommended looking for uninterrupted dividend payments, stretching back at least 20 years. 20 years! Think about that. It means the company paid out to shareholders through booms, busts, maybe even multiple recessions, without fail. This criterion alone filters out all the flash-in-the-pan growth stories and leaves us with steady eddies, utilities, consumer staples, big industrial firms, the kind of companies your grandparents might have invested in, and for good reason. Seeing decades of dividends is like seeing a long resume of trustworthiness. It shows the company respects its owners, the shareholders, enough to share profits consistently and it implies there were profits to share every year. 5. Moderate growth. Not too hot, not too cold. Unlike the enterprising investor, who we'll meet soon, the defensive investor isn't looking for the next meteoric rise. They're perfectly happy with companies that have shown moderate, reliable growth over time. Graham's guideline: look for a company's earnings per share to have grown by at least 1/3 over the past 10 years. That's roughly a gentle 3% annual growth rate. Nothing explosive, but solid enough to outpace inflation and signal that the business is improving steadily. This part is all about avoiding stagnation and hype. If a company's earnings grew much less, it might be stagnating, not good. If they grew astronomically, the stock might be a hot commodity selling at a crazy price. Also not good for a value-focused defensive buyer. Slow and steady improvement is the sweet spot. It shows vitality without veering into overvalued high-growth territory. 6. Never overpaying. Perhaps the golden rule for the defensive investor is don't pay too much, no matter how great a company looks. Graham quantifies this with simple, strict limits. He suggests not buying stocks priced at more than 15 times their average earnings over the past 3 years, and not more than 1.5 times their book value net assets. In fact, he offers a handy rule of thumb: multiply the PE, price-to-earnings ratio, by the PB, price-to-book ratio, and that product should not exceed about 22.5. For example, if a stock is at 15 times earnings, it shouldn't be above 1.5 times book value. 15 to 1.5 equals 22.5. If it's cheaper in earnings, say 10x, it could be a little higher on book, maybe up to 2.25x, and still pass. Why do this? It's to ensure you're buying $1 of assets earnings for a reasonable price, not $2 for every $1 of value. This pricing discipline is absolutely key. It builds a margin of safety, meaning you have a cushion in case the company's future isn't as rosy as hoped. The defensive investor refuses to get caught up in excitement. No matter how popular a stock is, if it looks expensive by these standards, they'll calmly walk away. And if it's reasonably priced, or better yet, cheap, that's when they strike. When you put it all together, you get a pretty inspiring picture. The defensive investor ends up holding quality companies that are big, financially solid, consistently profitable, dividend-paying, and bought at sensible prices. It's not flashy, but it works. Here's what most people miss. This boring strategy can actually outperform many hotshot investors over the long haul because it avoids the big mistakes. By steering clear of speculative frenzies and sticking to proven winners bought at non-crazy prices, the defensive investor keeps their portfolio out of trouble. There's an emotional component here too. This strategy is about temperament. It appeals to the investor who doesn't want to be glued to the ticker tape or reading finance news 24/7. It's set and forget with periodic checkups, and it's incredibly hard for most people to be this patient and disciplined. But that's why it can succeed. The defensive investor's mantra could be, I don't have to beat the market, I just need to avoid being beaten. Over years and decades, avoiding disasters and steadily compounding modest gains can lead to wonderful results. Before we move on, it's worth noting that Graham gives defensive investors a friendly nod to index funds as well. In fact, he suggests that one easy way to be a defensive investor is simply to buy a low-cost index fund that tracks the whole market. That instantly gives you diversification and a piece of all the leading companies without having to handpick each stock. It's a totally valid route for the truly passive folks. But whether you're picking individual stocks or an index fund, the core idea stands. Keep it safe, keep it sensible. As a defensive investor, you're playing financial defense. And as any sports fan knows, a rock-solid defense can win championships. The enterprising investor, boldly seeking value off the beaten path. Now let's switch gears and meet the enterprising investor, the proactive, hands-on stock picker who isn't satisfied with just average market returns. If the defensive investor is the cautious gardener, the enterprising investor is the treasure hunter, or perhaps the contrarian detective of Wall Street. This is the investor who says, I'm willing to put in extra effort and take on a bit more risk if it means I can find opportunities others miss. Graham's Chapter 15 is essentially a playbook for this more adventurous soul. But make no mistake, enterprising does not mean reckless. In fact, what blew my mind is that Graham's enterprising investor is just as disciplined as the defensive one, perhaps even more so, but they channel their discipline into a different kind of hunt. First, Graham acknowledges a hard truth: beating the market is difficult. Even professional analysts and fund managers often fail to outperform simple index averages over time. Why? Because stock prices usually reflect all the well-known information about a company, and the hottest, most excellent companies tend to get bid up to high prices, leaving little room for error. So an enterprising investor is swimming upstream from the get-go. They have to be smarter and more patient than the crowd. Graham basically says, look, it's challenging, but it's not impossible if you're willing to go against the grain of Wall Street's usual methods. Here's where the enterprising strategy kicks in. The enterprising investor looks for value in places others overlook. Instead of buying the big, already beloved blue-chip companies at full price, this investor pokes around in the bargain bin of the market. The goal is to find stocks that are priced well below their true worth, often because they're unpopular, ignored, or temporarily out of favor. Think of this approach as a scavenger hunt for hidden gems. It's contrarian by nature. You're often doing the opposite of what the crowd is doing. As Graham puts it, you might seek out companies that appear to hold no charm for the public, despite decent finances and prospects timelessinvestor.com. Where a defensive investor sees a boring, lagging stock and says, no thanks, the enterprising investor's eyes light up, seeing potential opportunity. So, how does one actually find these hidden bargains? Graham outlines a more flexible, but still rigorous, set of criteria, almost like the defensive rules, but with some leeway to allow smaller companies and special situations, as long as the price is right. Here are the kinds of things an enterprising investor might look for. 1. Fair financial shape. While the enterprising investor might dip into smaller or lesser-known firms, they won't touch a total basket case. Graham still advises checking that a company isn't drowning in debt and has a reasonably healthy balance sheet. For industrial companies, for example, he suggests current assets at least 1.5 times current liabilities, a bit less strict than the defensive 2.1 standard, and debt not more than 10% of the company's net current assets. In other words, the company should have more cash and assets than debt, not as impeccably strong as a defensive pick perhaps, but solid enough to not be on life support. By keeping this financial baseline, the enterprising investor avoids the real junk, no bankruptcies please, while still trolling in the waters of lesser-known stocks. 2. Earnings and dividends, a shorter history but still a positive one. Unlike the defensive investor who demands 10-plus years of perfect earnings and 20 years of dividends, the enterprising investor is willing to consider companies with a shorter track record, within reason. Graham's guideline, no earnings deficit in the last 5 years. So a minor stumble a decade ago won't automatically disqualify a stock if recent years look good. Also, he prefers companies that pay some dividend to shareholders, even if it's not an unbroken 20-year streak. This is interesting. Graham isn't necessarily hunting ultra-tiny Silicon Valley startups with zero dividends. He still likes the shareholder friendliness of a dividend-paying company. It's a sign that management is willing to reward investors, and it often correlates with more stable, mature businesses. Essentially, the enterprising investor says, I'll bend the rules a bit. I don't need decades of proof. 5 good years is enough. But I won't compromise on the basics of quality. The company has to be doing all right recently and throwing a bone to its shareholders. 3. Growth and prospects. The enterprising investor also wants to see that a company is moving in the right direction. Graham suggests looking for earnings that are at least a little higher than they were 5 years ago. So if a company's profits in the most recent year are greater than what they earned 5 years prior, that's a check in the box. This isn't about finding a company doubling its earnings every year. Those often come with sky-high stock prices. It's about ensuring the business is not stagnating or shrinking. Remember, we're often looking at companies that the market has overlooked, perhaps because their growth is modest or their industry is currently in a slump. But we still want to see some growth, which indicates resilience or potential. 4. The price must be right. Value, value, value. Here's where the enterprising investor really draws the line in the sand. If the defensive investor's credo is don't overpay, the enterprising investor's credo is buy at a bargain price or not at all. Graham recommends zeroing in on stocks trading at very low multiples of earnings. He gave an example of looking at stocks with a PE ratio under 10 and preferably below their book value or tangible assets. One rule he mentions: seek stocks priced at less than 120% of their net tangible assets, book value. That's basically saying, I want to buy a company for roughly what its assets are worth, or even less. In some extreme cases, Graham hunted for net bargains, stocks selling for less than the value of their current assets minus all liabilities. Can you imagine that? It's like buying $1 for 60 or 70 cents. These are rare gems, especially in bull markets, but they do appear in market downturns or in neglected corners of the market. And when you find one, it can feel like a eureka moment, the kind of thing that definitely blew my mind when I first learned about it. It turns out the enterprising investor is not chasing hot growth stocks at all. They're often scavenging among beaten-down, forgotten stocks that everyone else has left for dead. As Graham notes, the best time to find these bargain issues is during a bear market or market correction, when pessimism runs high and even good companies might be selling for silly low prices. The enterprising investor is ready to swoop in during those dark times, buy a bunch of these undervalued stocks, and then, critically, wait. Now, patience is absolutely vital here. Graham stresses that if you're going to follow an enterprising strategy of buying bargain stocks, you must diversify and be patient. Not every pick will be a winner. Some undervalued stocks can stay cheap for a frustratingly long time, or even go bust if you misjudged them. So you don't put all your chips on one company. Instead, you build a basket of bargain stocks. Graham suggested you might hold on the order of 30 of these to spread out the risk. And then you hold them, sometimes for years, until the market eventually realizes their value. As Graham Riley points out, you must not lose patience if they fail to advance soon after you buy them. This is perhaps the toughest part emotionally, watching a stock do nothing or even drop for a while after you bought it, resisting the urge to panic or give up. But that's the enterprising investor's mindset. You did your homework, you bought with a margin of safety, and now you give it time for the thesis to play out. What are some examples of enterprising stock picks? Imagine a solid, mid-sized manufacturing company whose stock is down 50% this year because the entire industry is in a slump. The company's earnings have dipped, sure, but it's still profitable, still paying a small dividend, and its balance sheet is strong enough to weather the downturn. The market sentiment is awful. No one wants industrial stocks right now. As a result, this company's shares are trading at, say, 8 times earnings and right around book value. To a defensive investor, it looks risky. The recent earnings drop is scary. To an enterprising investor, it's exactly the kind of contrarian opportunity to investigate. If their analysis shows the company's core business is sound and likely to recover in a year or two when the industry cycle turns, they'll eagerly add it to their basket. Another scenario, a small tech firm with a great balance sheet, tons of cash, little debt, but it's totally off the radar. Maybe it's in a boring niche. It consistently made a bit of profit each year, but growth is anemic, so the market ignores it. If that stock is, say, trading for less than the cash the company has in the bank, net of all liabilities, an enterprising investor would say, "Holy smokes, this is deep value," and snap it up, expecting that eventually either the market will wake up or the company might get bought out or liquidated for more than the current price. These are the kind of plays that make the enterprising path exciting. It's truly a hunt for mispriced or neglected assets. However, let's be crystal clear. Enterprising does not mean chasing every high-flying speculative tip. Graham actually warns against paying a premium just because you're enthusiastic about an industry or company. The enterprising investor must still avoid the trap of buying trendy growth stocks at insane prices, because those can lead to disaster when the hype fades. In Graham's words, never pay a high price for a stock in relation to its earnings and assets due to enthusiasm. Instead, he suggests a savvy, enterprising investor often does the opposite. For instance, look at cyclical companies like automakers, steel companies, etc. During the down part of their business cycle, when their current situation looks bleak, near-term prospects are grim, and thus the stock price is very low, fully reflecting that pessimism. That's usually the best time to buy such companies, when no one else wants them. It takes guts, of course, to buy when outlook is dark, but that's where an enterprising investor's courage and conviction pay off. Here's what most people miss. The enterprising approach isn't about recklessness. It's about contrarian courage and thorough research. It's being greedy when others are fearful, to paraphrase Warren Buffett, one of Graham's star students, but doing so with eyes wide open and facts on your side. Graham even gives a peek into some strategies he personally used back in the day, things like workouts or special situations, merger arbitrages and liquidations where a profit could be captured, related hedges, pair trades of undervalued versus overvalued companies in the same industry, and activist moves, buying enough of a mismanaged company to push for change. These are more advanced tactics and not for everyone, and Graham doesn't suggest the average enterprising investor needs to do all that. His core advice is more straightforward. Look diligently for cheap stocks of decent companies, and don't put all your eggs in one basket. Develop a method to your research. Graham even describes a method of combing through stock guides, like the old S&P manuals, and using simple filters to shortlist stocks, e.g. low PE, solid financial condition, etc. It's almost mechanical. You create a list of candidates, then analyze each one deeper to see if it's truly a bargain with a catalyst for improvement. This requires more work, reading financial statements, news, industry outlooks, basically doing your homework on each stock. That's why it's called enterprising, or sometimes aggressive investing. You're actively putting in effort, and you're willing to face the possibility of being wrong. Jason Zweig, in his commentary on these chapters, wisely suggests that most investors should be honest with themselves about whether they can really succeed as enterprising stock pickers. It's painstaking and difficult work to consistently find winners that beat the market. If you don't have the time, interest, and emotional fortitude for it, there's no shame in sticking with the defensive approach, like an index fund, for the bulk of your money. In fact, Zweig's advice, which I find super practical, is to maybe try stock picking with a small portion of your portfolio after doing at least a year of practice, like paper trading or a fantasy portfolio, to see if you can actually hack it. He even floats the idea of a 90-10 split. Put 90% in something safe like an index fund or defensive picks, and use 10% as your enterprising playground once you've proven to yourself that your picks can outperform. That way, even if your active picks go south, you've secured the majority of your wealth. This down-to-earth commentary really underscores Graham's core message: know yourself. Not everyone is cut out to be an enterprising investor, and that's okay. Conclusion: the mindset of the intelligent investor. Whether you felt more drawn to the calm, steady path of the defensive investor or the active, contrarian journey of the enterprising investor, there's a unifying thread. Both approaches demand the mindset of an intelligent investor. And what does that mean? It's not about being a genius or having a crystal ball. It's about patience, discipline, and emotional control. It's about researching your investments and insisting on a margin of safety, not buying hype, not getting swept up in fear or greed. Benjamin Graham's ultimate lesson is that successful investing is about character as much as intellect. If you choose the defensive route, you commit to consistency. You won't try to time the market, you'll diversify, and you'll stick to quality and fair prices. You'll refuse to be tempted by the latest fads because you know slow and steady is your game. If you choose the enterprising route, you commit to diligence. You'll turn over lots of rocks to find a few gems, you'll zig when the market zags, and you'll cultivate the resilience to hold on when your picks are temporarily unpopular. In either case, you must be disciplined and consistent, refusing to abandon your approach even if it's out of fashion. The great investors, as Zweig notes, don't constantly change strategy or chase what's hot. They think deeply, act with conviction, and tune out the noise. At the end of chapters 14 and 15, you really get the sense that Graham is handing us a mirror. He's saying, look at yourself, be honest about your time, skills, and temperament, and then pick a path. The intelligent part is staying true to that path. Defensive investors shouldn't suddenly fling their strategy aside because they got a hot stock tip, and enterprising investors shouldn't lose their nerve and sell everything in a panic because some picks take too long. Graham's approaches are built on decades of market wisdom. They work, but only if you work them faithfully. So, whether you're the tortoise or the fox in our opening story, remember that the stock market rewards those who know themselves and stick to sound principles. As Graham might say, better to be an intelligent tortoise or fox than a foolish mule getting kicked by Mr. Market. The defensive investor's portfolio may not shoot the lights out, but it will be standing strong through the worst storms. The enterprising investor's portfolio might zigzag more, but it has the potential to snatch truly exceptional bargains that make it all worthwhile. Both are valid, and neither is free money. You pay either with effort, enterprising research, or with restraint, defensive patience. In the grand finale of it all, Graham's message is empowering. You get to choose the strategy that fits you, and if you do it right, you can achieve your financial goals without riding the Wall Street roller coaster of emotions. The intelligent investor's mindset is a kind of quiet confidence. It says, I won't get rich quick, but I will get rich slow and stay rich. It's the confidence of knowing that whether you're picking ultra-safe stocks or bargain basement rebels, you have reason and wisdom on your side, not just luck. And that is how the intelligent investor wins the game, no matter which road they take. Ultimately, stock picking is as much an art as a science, and Graham has given us two masterpieces to learn from. The defensive and the enterprising approaches might paint in different colors, but both rely on the sturdy canvas of value investing principles. By understanding the differences and the discipline each requires, you're already miles ahead of the average speculator. So ask yourself, which approach speaks to me? Embrace it, commit to it, and carry Graham's timeless advice with you. Never forget that an investment is smartest when it's most businesslike, grounded in analysis, not emotion. That's the real secret sauce, and it's what separates the intelligent investor from the crowd. Now, take these lessons and look at your own investing journey. Are you building your fortress or charting your treasure map? Either way, do it with Graham's principles in your heart, and you'll be well on your way to financial success with a smile on your face. Here's what most people miss. In investing, boring is often beautiful, and effort is often rewarded. It just takes the right mindset to see it. Graham showed us the mindsets, the rest is up to us. Happy investing, and may your chosen road take you exactly where you want to go, safely, prosperously, and intelligently.